Today we saw the release of Canadian GDP figures for August, which disappointed the markets somewhat. Joining me now to discuss the data release alongside a more general view on the Canadian economy as a whole is Benjamin Reitzes, Senior Economist and Vice President at BMO Capital Markets. Benjamin, what do you make of the figures? Also regarding the Bank of Canada's and the government's revised economic outlook on expected growth for this year and next year, are these in line with your consensus estimates at BMO Capital Markets?
August GDP number was certainly disappointing. Contraction in August was unexpected. The consensus call was for a 0.2% increase in GDP, and we saw minus 0.1. We thought it'd be a little bit weaker than the consensus call, but certainly not this week. There were a couple of special factors. There were some shutdowns in some mines and some oil and gas rigs, but that doesn't account for all of the weakness. On the services side, there was weakness as well, and that was pretty broad-based, with about half the services sectors reporting a decline on the month. So certainly disappointing, and maybe suggests that there's a little bit more underlying weakness in the Canadian economy than we previously thought. Right now, for the fourth quarter, we're at 1.9%, and if we get a big rebound in September, it's possible we could push our fourth quarter number higher. But 2.5% for the fourth quarter, maybe for every quarter of 2013, seems a bit optimistic right now.
Now, the government has taken a number of steps to curb the nation's household indebtedness. The most recent changes have not been implemented that long ago, so is now the time to observe the impact of those measures before considering other options?
Definitely. I think right now the government is just going to wait and see how things play out on the housing front. We've already seen some signs of cooling. Housing was actually one of the factors that weakened the GDP number in August, and we've only had a couple months of housing data since the new rules came out, so we're really unsure as to how much of an impact it's had so far on housing, but it should provide or cause some cooling in the housing market, and that will take the pressure off.
But should our focus here really be on the speed at which this debt-to-income level has been rising rather than the level itself?
I think that's probably a good way of looking at it. The level itself is somewhat arbitrary. There's no level at which is an emergency level, where some countries exist at 200% and they're perfectly fine. Others well below that and they're fine as well. But the pace at which it rises or falls is something that we should be looking at. If it does continue to rise at the pace that it has over the past few years, that would become a worry, because at some point the debt is going to become an issue. When interest rates do rise, that debt's going to become more costly, and then will be a burden on the Canadian economy.
You mentioned it briefly a moment ago, but what about the developments in the Canadian housing market and housing prices going forward?
We see things slowing, probably not drastically though. Prices are going to be negative on an average basis. But if you do use comparative sales, there's the MLS Home Price Index, which compares same home sales. It adjusts for the type of home that's sold. Those prices probably aren't going to fall meaningfully, if at all. They might just go in the very low single digits, maybe fall to around a 0% increase, say flat year over year. So housing will cool, but probably not substantially.
Bank of Canada Governor Mark Carney still claims that the greatest risks to the Canadian economy are external. Do you agree? And if so, amongst the list of investor concerns, what external and internal factors concern you the most?
Well, I think we'd agree with Mark Carney. Europe still remains a pretty significant risk for the global economy. If things go off the rails in Europe, that would be a pretty significant negative. You also have China potentially continuing to slow. There have been signs that things are bottoming out in China, but that hasn't been fully borne out yet. We still have to wait and see how the data turn out over the next month or two. And on top of that, you have the U.S. fiscal cliff. If the U.S. government can't come to some kind of agreement, if the new president or President Obama, if he's reelected, can't come to agreement with Congress, it will cause a recession in the U.S. Essentially, that would be a pretty meaningful negative for the U.S. and for Canada as well. Internally, household debt is really the one main worry that I think everybody has. If the housing market continues to just boom, which really isn't what the base case is, but it is possible. Home prices are already elevated in some regions, and if that trend were to continue, you would get to worrying levels. Right now, we're not quite there, but if the trend were to continue, that would be a concern.
Well, in Ottawa yesterday, he seemed to give some clearer indications as to when he might raise the bank's key benchmark. But what are your views on the current and future stance of their monetary policy?
We think policy is appropriate where it is at 1%, and moving rates lower, as you've seen elsewhere in the world, really isn't appropriate for Canada. We're already at very low levels, and the reality of it is the difference between 1% policy rates and 0.5% or 0.75%. It's not that significant, and the bank's been harping on households to kind of slow down their borrowing really watch what they're doing and then not borrow irresponsibly. So they want to stay consistent on their message, and their messaging has been a bit confusing over the past few months, but they cleared things up. Their tightening bias is clearly a long-term one. They want to demonstrate that they're nowhere near cutting rates, but rate hikes still are probably a long way off. We don't think the bank will hike rates until the fourth quarter of next year.
We've got the Canadian unemployment report coming out at the end of the week on the same day as NFP data is expected to be released. What kind of picture do you see being carved out regarding the Canadian labour market?
Well, we have an average 14,000 increase for October penciled into our forecast, and the jobless rate holding steady at 7.4%. I mean, until the underlying economy really improves, job growth probably is not going to pick up very much, and the jobless rate probably will hover around the low 7, mid 7.5 range.
In your opinion, what are the main drivers we're looking at here for the Canadian dollar?
Risk sentiment is still the key driver for the Canadian dollar. And in any given day, you can have some data releases having an impact, and we're seeing that today with the GDP number being weaker than expected. The dollar sold off immediately after that, and it is about 0.5% weaker. But in general, the outlook for the global economy and how that impacts risk appetite is probably going to be the key driver for the foreseeable future, the next few months at least.
Benjamin, thank you very much for that in-depth look at the Canadian economy. We covered a lot there. Now, for more exclusive Dukascopy TV interviews just like this one, stay tuned. But for the moment, viewers, goodbye.